Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. All right, everyone, Happy New Year and welcome back. In true 2022 fashion, I should say, we've started 2023 with some quite big market moves. And I guess that's the way that we ended the year. It's been a couple of weeks since we caught up. So Jan, let's start with you. And perhaps you can just let us know any of your kind of key themes and thoughts that we were talking about into the end of 22, if any of those things have changed or if you're still on the same kind of trades and views.
Yeah, well, one of our key themes going into 2023 was that we are going to get this bull steepener in the curve that you usually see with recessions and monetary policy turning around. But we warned investors to not be sort of premature about that and not really look for that steepening to materialize until like spring this year rather than early on in the year, because we still, anticipate the Fed rhetoric not peaking, and it's sort of kind of what we're getting now from commentary from public officials too. So while we do maintain as a medium-term view that the curve will steepen and like the front end will reprice future cuts by the Fed, called like 2024, even more than what it has now. Tactically, we suggested that it makes sense to be kind of like short 10-year yields at 3.5%, and because they did fall substantially, but not really too much to back that drop. We do expect yields to go lower again this year, but not in a very fast and disorderly fashion, because there's still a lot of work to be done on the monetary policy side, and we still think that the Fed will push back against these early loosening in financial conditions, as that has been sort of their kind of like the main tool for trying to bring aggregate demand and inflation lower.
So it feels like we've got off to a pretty quick start in the US. We've had what feels like a jam-packed week of data, and we also had the Fed minutes on Wednesday from their kind of pre-Christmas meeting. Now, listeners might recall that we had a slightly more hawkish take on the meeting than the market seemed to react to, we thought. So what was your take on A, the minutes this week, and B, anything else that we've kind of learned from the data as well?
Yeah, so one thing at the December meeting that surprised us was that the forecasts submitted by the Fed officials showed a very kind of concentrated expectation for the rate path in 2023. The median forecast was 5.125%, but there really wasn't all that much dispersion in the outliers. The range stretched from 4.8 to basically 5.6%. Everyone else was in between. So what does that mean for minutes? Well, when you give forecasts that are all clustered like that, it is hard to present a document that suddenly shows all these diverging views. And that's exactly what we got. We didn't really get anything too kind of like out there that would suggest that there's disagreement brewing within the FOMC. We didn't really get any guidance for the February meeting, whether it should be 25 or 50 basis points. Of course, we think that will be dependent on the upcoming jobs and inflation data. So far, we have penciled in 25 basis points, but it really feels like a close call between whether to step down again or maintain a 50 basis point hike base. And I guess I should point out that the minutes also said no officials expected rate cuts in 2023. That caught some headlines, but you look at the forecasts, that's fairly obvious that no one really expected cuts in 2023. Whether that can change, it could. It's not our base case that we're going to see cuts, but just like no one expected rates to go about 5% a year ago, things are pretty fluid and dynamic. And one interesting thing that we noticed was that the board staff projections for inflation were lower than what Fed officials had submitted with their forecasts in December. So there's a little bit of divergence there that I think is worth tracking and see how, like whether the forecasts were influenced by like near term, I don't know, like kind of desire to keep like conditions tight, or because we have seen, well, hopefully we have seen inflation peaking in the US and now trending towards kind of like lower levels.
Okay, so looking forward then, we've not just had a busy week this week. Can you tell I'm jealous because we've not really had much going on in the UK yet. We've not had just had a busy week this week for data, but we obviously have a busy couple of days or week ahead really. We get NFPs, which may well be out by the time people listen to this. So I won't pinpoint you to a number there, but we have NFPs and then obviously inflation data next week. You mentioned that that's going to be pretty key in defining whether it's 25 or 50 for the Fed in February. How are you kind of set up going into these data prints? What's the market thinking about this, and how pivotal are both of these prints?
All right, let me start with the jobs number because it's tomorrow. Today, just before we started recording, we got the ADP employment figures, which were again above consensus, above economists' forecasts at 230,000, 235,000 versus the Bloomberg headline of 150K going into it, and the previous month was revised higher by another 60,000 jobs. ADP did change their methodology, so now the tracking error has fallen a little bit compared to the non-farm payrolls, but it certainly implies that we could see a higher than consensus number for the payrolls as well. Our forecast is just below that. We have 175K for new jobs added for December compared to 200,000 that I can see on Bloomberg right now. That's a step down from the prior month. But it still implies that the labor market in the U.S. remains fairly robust. You combine that with all of the jobless claims data, which again for the week show that they fell. You're really not seeing this deterioration in the labor market quite yet in the U.S. Of course, there's a lot of statistical measures that are used to control for seasonality in these releases, and they have been a little bit. They could have been exaggerating numbers in either direction since the pandemic, but by any means, if you look at wage increases and all sorts of wage trackers from employment surveys to the Atlanta Fed, you can see that wage pressures are still there. So we are looking for 175. It's slightly below consensus, but you can pretty much read it as in line with consensus. And I think the Fed might need to see a little bit more weakness in the jobs to kind of take that as a sign that the market's weakening. And moving on to inflation, we actually again revised our forecast lower for the next 2 months. For December, January, and February, mainly on account of two things. We are looking for lower used car and new car prices, and we kind of gauge that from transactional data and wholesaler prices. And additionally, we had a congressional legislation, the most recent congressional legislation on the budget put a number on the Medicare reimbursements to physicians, which showed a drop of 2%. So that's going to feed somewhat into CPI and fully into PCE. But once we incorporate that, we have a lower medical component for inflation for the next 3 months because it kind of resets in January. And what does that mean? So we are at negative 0.16% for headline, and we're at 0.2% in core. So that's about 10 to 15 basis points below what the market has when you look at kind of the unrounded numbers. So I think if we get those numbers, if we get our forecast, I think markets could be a little bit more confident that the Fed could step down to 25 basis points.
Okay, great. Thanks, Jan. You definitely sound like the Christmas lurgy has finally got to you. So I will let you go and rest up before next week. And Giles, we'll move over to talk about Europe. There's been a lot going on there this week as well. I guess the major focus has been around the inflation print. Started the week with Germany coming in lower than expected, and other countries have followed suit, such that it looks like tomorrow, we're recording this on Thursday, so tomorrow's print that we will have by the time this goes out for the Euro area as a whole will be much lower than expected. It really seems like the market wants to buy into this kind of peak inflation story as a big buy in rates. Do you agree with that on the European side?
Listen, I think it has been a little bit of a surprise, although I think it can easily be overstated because I don't think that there were very many people who didn't think that inflation coming down was going to be one of the big stories of this year. The real question is always going to be how quickly inflation was going to come down. And just because we have, a reasonably sizable undershoot compared to expectations doesn't necessarily tell you that the trajectory over the course of the year is really going to be very different to what people thought. And I don't think that will be the central bank assumption either. So at the moment, I don't think this is something that you should be reading too much into. But I think it does mean, hopefully, it means that there's, I guess, a lower peak there in policy rates than the market had in mind is a possibility. That has always sort of been our base case. The market, actually, when I came back on at the beginning of this week, was looking for something like 3.45% peak rate for the ECB. We're at 3%, of course, which we think we'll get to in the next 3 meetings. But that already seemed pretty punchy. So I think a little bit of give back there is something that we are looking forward to, that we think you go with. But the lower inflation story, to the extent that it's a story, has also sort of mixed in with slightly better activity indications, in particular the PMIs this week. But overall, the sense from the activity data has been better, and so that's kind of linked to what we see in this sort of quite good moment persisting for credit, for example. Now, it seems like we are looking at more of a sort of soft landing narrative taking hold here, and I don't think that is very bullish for rates overall. I think you can talk about being a little bit bullish in the front end, but above all, I think that this should be a bit of a curve steepener.
Okay, let's get on to what you talked about as being the other kind of major market focus this week, because I think that probably plays into the longer end view of that curve steepener and where we'll see the steepening being driven from as well. And that's obviously supply. It's kicked off in a big way already this week, as we usually expect it to in the euro area. Is the market kind of set up to digest all of this supply that's come and going to come over the next couple of weeks?
Well, so far it seems to have been. Obviously the inflation data has helped. I think that there probably was a little bit of positioning that had been built up in the late part of last year, really after the central bank meetings, and actually really possibly since the ECB stopped its asset purchases, which some people, including us, had signalled could have been a bit of a trigger to go short the market. And so, and I think that there's also been probably carried over from last year a decent amount of pent-up demand for credit. And of course, the credit market has really opened very, very strongly this in terms of the total supply, but also the demand to meet that so far just this week. Listen, I think if you think back to last year, when we actually started the year very strongly as well in fixed income, there was a lot of pent-up demand that was carried over from 2021. And it really didn't clear until the end of the month. It was only in that sort of window between the start of February and the start of the war that we had quite a big sell-off. And so eventually, I think the indigestion caught up with the market. This year, I think at least my expectations, you're going to see that a little bit sooner. Okay, again, just a comparison with last year. We're going to have something like 80 or 90 billion extra net EGB supply just in January compared to last year. All right, so even if you think that you're left with a little bit of a positioning sort of difficulty, which maybe is part of what we're seeing this week, I think that ought to be washed out relatively quickly. And I think that as I have done all along, I still think that you're looking at supply as a key bearish driver for the next several weeks.
I guess part of one of the other impacts of supply has been what the activity that we've seen in swap spreads over the last couple of days, both in Europe and the UK. We've seen swap spreads tightening, or bonds underperforming swaps quite strongly. That's one trade that we both like, I think, in Europe and the UK. We've been talking about that. Probably not off, probably quite consensus at this point. I think we didn't get a huge amount of pushback to that view when we were kind of talking to clients about that last year. Do you think that this continues, or has it gone far enough for now?
Well, yeah, I do think it continues. I mean, sometimes consensus trades are the right trade, to be honest with you. I think this is one of them. Structurally, I definitely do think that this is a go with trade for the year. I mean, we've spoken about it before, but I think it's about less collateral scarcity. I think it's about lower volatility, and therefore the volatility that was driving a certain kind of higher level of collateral requirement in the market for things like margin posting and so on. I think that is also falling back. I think the better credit sentiment is also naturally plays towards an asset swap tightening regime, and I think that having consolidated higher rates, I think that we're going to see less bank ALM paying as well. So I think all of that pushes in the same direction. That said, it's been sort of turbocharged by a few days of very, very heavy financial supply in particular. And if you look at some of the relative value charts, the kinds of curve indicators, things like 5s, 10s, 30s, for example, that have been quite strongly correlated with asset swaps, because the underperformance of the 10-year has been one thing that's been also driven by this ALM paying from banks. That now looks quite out of line, and so it doesn't look like necessarily the best risk-reward expression for some of those themes. Nonetheless, I think it's something which we go with, as I've said. And maybe not for an in-depth discussion right now. I also think that there's a little bit of an argument. In fact, there's quite a strong case, with quite a few sort of moving parts that argue that maybe asset swaps ought to be sort of more of a widener in a lower rate environment. So if we correct back, and perhaps if the curve steepens as well, I think that could be part and parcel of a bunch of things which could be a risk to the asset swap tightening trade. But broadly speaking, that's not our view. But anyway, I think we can come back to that on another day, because we've already gotten into the weeds a little bit too much there. So I'm going to turn it back to you, Imogen, to talk about the UK. You've already said it hasn't been the most alive market this week, but it's going to spring to life. Any changes in your view since we last spoke?
Well, to be honest, Giles, as you say, it's been kind of from a UK specific angle, a slower start to the year. We haven't really had a huge amount of data. We've not had a lot of supply. We haven't had any central bank speakers. So it feels like all the action's happening elsewhere this week a little bit. But I guess in terms of, what have we learned since we last spoke, there's nothing that's really changed our key views that much. The data that we have had this week, I guess the highlights has been the PMIs, which largely, like you were saying on the European side, Giles, kind of are indicative of this idea that we will have a shallow recession in the UK, but actually by the end of this year now, 2023, we might see the worst of that recession behind us, and this could be more of a soft landing and a less sharp slowdown than we might be used to. We're seeing falling, I guess, energy prices like we are elsewhere. but the BRC inflation data and the Bank of England's decision maker panel survey both show still quite elevated inflation expectations. And so, or certainly for the decision maker panel on the wage inflation side. So, there's still tightening to be done by the Bank of England. But again, like you said, on the European side, perhaps not as much as the market is pricing in. The market's moved a long way towards our view. So we have already had quite a bit of a dovish repricing. So I don't think it's kind of particularly shocking for us to still be, to think that there's only a little bit further to go. But we now have a peak of 4.25, or rather still have a peak of 4.25. But after the December meeting, think that they get there by doing another 50 bits in February and then 25 basis points in March. So the major difference still between us and the market is that we think that the peak is lower, but earlier than the market is pricing in. We've always thought that 2023 is going to be about the kind of supply side of things in the UK and this, funding the fiscal deficit. That hasn't changed, although it's got off to a bit of a slow start. Again, like in Europe, our key views there have been to be bearish rates, but also be short asset swaps, so short bonds versus swaps. And again, we have seen that move relatively quickly over the last couple of days. I think not as much as we're seeing in Europe, but some financial and corporate issuance there is helping that. And then just, I guess, the only other thing that we've learned on that side of things since we last caught up is the Bank of England's schedule for quantitative tightening over this quarter, which will include long dated bonds. So there's a bit of a question mark around whether their kind of regular QT would include long dated bonds or not this quarter, given that they do still have some to sell within their temporary holdings. But all in, we haven't really had all that much new news, I would say, over the last couple of weeks. So it really leaves us with the same kind of themes heading into 2023. Bearish rates, steeper curves, short swap spreads, short gilts on the cross market. I'm probably missing something, but I think that's the key ones.
Okay, fair enough. It has been a little bit of a slow start compared to US and Europe, particularly on the supply side. That is going to come, of course. Maybe you could just give us a quick word on when you think that will start.
Yeah. Well, I guess we'll talk about this in more detail in the next couple of weeks. But, I think the main supply event that we should look towards now is the syndication in 2 weeks' time. So that will be a new 30-year bond. That will be when supply starts to feel its heaviest, I suppose, to begin with this year. So we haven't had any QT this week, no kind of regular QT or the temporary elongated gilts and linker sales that were really feeling quite heavy at the end of last year. The last week of last year, I think the Bank of England was selling back sort of between 2 and 3 billion to the market in each auction that were coming 3 times a week. So that was what was really adding to the duration that the market was absorbing in the last couple of weeks of last year. So once that kicks off again next week, and then we have the syndication the week after, that's when supply will start to feel heavy. But I think it's important to remember that relative heaviness, I suppose, is actually what's going to feel normal for the rest of the year. So although it will be heavy compared to the last few weeks that we've seen, and heavy compared to what felt normal in 2022, kind of excluding October and November, I suppose, actually that heavy schedule is what the rest of this year is going to feel like. So I think the syndication will focus everyone's minds on that supply schedule. But it should remain in focus for the rest of the year, and how heavy the weeks felt with the Bank of England coming every single day and the DMO coming a couple of times a week in November is really how it's going to feel through all of 2023, I think, and certainly the next couple of weeks whilst the Bank of England still has those temporary holdings left to sell. Obviously, they only have a small amount left now. I think they have about 6 billion nominal left to go, most of which is conventional gilts, not linkers. So they sold a huge amount last year, and I think that they will be relatively happy with how well that's been absorbed, but that's kind of very small in the context of what the DMO also has to issue this year, whilst the bankers are still doing their regular QT auctions as well. So Still the same focuses for 2023, I think, but let's see, it'll all kick off a bit more for the UK next week. So hopefully have some more interesting things to say there. But we'll catch up again then. I'll let you both go. Just a reminder to our listeners that if they like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks everyone. See you next week.